To his day, August 1st, we are now firmly entrenched in the back half of 2023. This is Market Call, 1 p.m. on the East Coast, 10 a.m. on the West Coast, somewhere in the middle of the country. Now I've offended most of you, if not all of you, but that's what I want to do. This is Market Call, Dan Nathan. Today's Market Call brought to you by CME Group, where risk meets opportunity. Of course, FactSet Financial Data and Analytics, powered by Tomorrow. In just a few minutes, not Butters, but Sean Ryan of FactSet will be joining us. We're going to break down the banks. He's done some very interesting work on the banks. We're going to talk about that. Extensive work. How are you, Dan?
Good.
By the way, Major League Baseball trade deadline some 5 hours away.
Yeah.
I haven't heard. I think the Giants of San Francisco made a couple of moves. I think the Yankees find themselves in a really odd position because they could be either a buyer or a seller. And quite frankly, it's a coin flip at this point.
No doubt.
I mean, it's a disaster what's happening in the Bronx.
How are you feeling about our little Wayne's World setup here, like that we got?
We have a new desk here.
Yeah.
That Art Jacob put together. I don't know if Rafus helped him.
No.
And we have some lax bro that's hanging out with us now.
We have a new intern who's not been helpful yet, but will be.
No, but he can be. I like him.
This is more fun. This is fun to be in person like this.
IRL.
Guy. Yeah.
It's a nice desk. But listen, doesn't appear like a lot's going on. The S&P's down 14, 15 handles. But once again, it's not necessarily the broader market. It's some of the other things that are happening around the edges, as they say. It's going to be an interesting day because we're going to hear from AMD. We'll talk about that in a second. We obviously had some earnings last night, had some earnings this morning. This is a busy week. But what are you looking at the S&P here? Because, 14 handles, not a big deal.
It was really funny. So yesterday, last night, I guess on Fast Money, which is on at 5 o'clock on CNBC, we were talking about how, it's funny. I left with like 10 minutes left in the close, to go head up to do the program. And in that time, I think the S&P rallied 15 handles.
Ramp.
Like in a straight line, which is really funny. So it's the last 10 minutes of the trading day on the last day of the month in July, and some program goes in there and just rips them right up there. And it's funny. So like this morning we're down 30 handles or something. We just rallied another 10 handles like off the lows. The market just doesn't want to stay down. And it's really interesting because we're getting to a point here where pretty soon, a lot of investors, a lot of strategists are going to be focusing on what is the 2024 earnings estimates right now. I mean, I think a lot of folks thought we'd be down, let's say 10%, like at the end of last year when the S&P was trading near its lows. That's on an earnings basis, year over year. Right now, expected to be flat-ish or so. So I just don't know how we don't really have a meaningful earnings recession where we have year over year decline in earnings. The S&P's up, close to 19 or so, 19.5% here, Guy. I mean, all of a sudden, if everyone's going to be focused on 2024 earnings, with rates where they are, with the dollar coming, there's just so many cross currents. It's going to be a really hard one to figure out. I just don't know how we get out of this period without at least one bout of downward volatility in the stock market, right?
And that's what Elizabeth Young's been talking about for a long time. I mean, she's been saying it for months that she's hard pressed to believe by the end of this year, we don't have something that happens that we're all obviously say that makes sense in retrospect. To think we're going to get through this unscathed, and quite frankly, other than Silicon Valley Bank and maybe First Republic, this year has been pretty much unscathed, and we're in the beginning of August. So your point about earnings, I think it's the right one. Again, it's what's the right valuation in this environment. We're going to talk about banks. Credit, I think, is becoming a concern for some people, and earnings do matter. And you say all you want, Apple's going to be a big deal this week. I mean, just the magnitude of the stock and where it's trading in relation to its previous all-time high, which I think was around 176 or so, as opposed to Microsoft, which made pretty much a matched high from its 2021 November highs. That's going to be really interesting to watch.
Yeah, and it's worth noting, I mean, Microsoft, $2.5 trillion market cap, and the stock has sold off 10% from its highs July 18th when they announced some of the pricing for their AI tools, the Copilot suite of products on Office. But, when you think about Apple, again, it's a $3 trillion market cap trading very near all-time highs. Very different exposure than a Microsoft. Microsoft's really talking about enterprise. It's talking about, obviously, the strength of their cloud business, and then obviously what they're going to be able to layer on as far as some of these AI tools. Apple does not have any of that. Apple has a lot of China exposure. Apple has a lot of consumer exposure. If you look at a lot of tech earnings so far, we know that PCs and smartphones are weak. Okay. So we also know that the quarter leading up to when Apple refreshes their smartphone, seasonally is a weak quarter. So for me, what's most important about Apple is, let's just say it comes in line and they're able to guide in line or whatever, they don't give such great guidance anymore. Then the question is, how much does the stock sell off, right? If it's not a beat and raise, because I think investors have gotten to a point where they don't mind 30 times earnings for high single digits earnings and sales growth for a name that has the sort of stability, right? In I don't know. It's a tough one here, man. I mean, I'm hard pressed unless this company guides down, which I think is, in a material way, not that likely. I just don't see a big move out of the stock one way or another.
Well, ask yourself at this point, post earnings, what are they going to say that's going to move the needle to the magnitude that it's been moved over the last couple of months? Again, I think hard pressed is the right expression, and a 10% move ish to the downside gets you effectively back to that prior all-time high, and that's not unreasonable. It's going to seem cataclysmic, but I don't think it will be.
What was that breakout? It was like 184 or something.
I think it was more like whatever it was. I thought it was 176. My point is, you understand what I'm trying to say here. Let's look at S&P futures, because we do Tuesdays through the lens of futures. And again, we mentioned the fact that down 14 or so handles in the S&P, not a huge deal. That prior all-time high, the one that we broke through,
43.50,
retraced to, and then took off from, I think is in play. And again, it's worth mentioning that each passing day, we get farther and farther away from the moving averages. So at a certain point, you do see mean reversion in everything. And why should the S&P be impervious to that?
Yeah, I guess the steepness of this last leg is the issue here, right? And if we're going to invoke our friend Carter Braxton Worth of Worth Charting, I mean, the unchecked nature of it. And I like the fact that you talked a little bit about, 43.50. You had that August 2022 breakout level. It went up, I don't know, 50, 75 handles in a straight line. Then it checked back. And then it made that move. So to me, I guess as we get towards the end of earnings season, if we get, the data, if the data continues like we saw on Friday, the inflationary data, that's the sort of thing that I think will squarely put the Fed, as we get towards the end of August to Jackson Hole, in a bit more of a, I don't know, like the less hawkish stance. Let's just put it that way.
And we'll see.
And so all supportive of equities, I guess.
We talked to TRB.
That was the reform broker.
That's what that stands for?
Josh Brown.
So you don't say the TRB because
that's what the T is for.
That's what the T is for. Yeah. If you people out there, and I've said this before, there might be some new viewers or listeners.
Yeah.
If you're one of these people that says PIN number, you can leave now.
Yeah.
You can just
because the P, personal identification, and the N is for number.
Right. Yeah. So when you say PIN number, it's PIN. It's when you say what's your PIN number. Yeah, it's unnecessary. That's just the more you know type of thing. Yeah. I mentioned the TRB because he's been bullish and correct, but even he, in our conversation today, said he's somewhat cautious now for, I don't want to say the foreseeable future, but given the run that a lot of these stocks have had, and you say it all the time, even if you're the most ardent bull, the best thing that can happen in this environment is to see some sort of pullback. In the case of the NASDAQ, which we'll look at futures, to that uptrend. And in the case of the S&P, back to that sort of 43.50 level.
It's really funny. So PIN number, and people also say ATM machine.
I do neither.
I know, but think about how attached those two acronyms are to each other. One would use an ATM card. That would be the proper use of ATM, but then an ATM machine. Yeah. And then the PIN you would use to activate.
What's your PIN number? You know what I feel like saying to people say that I can't say it because our sponsors won't like it.
No,
but maybe I'll put it on the Twitter offline.
Well, that's
or
the
in
proper,
the chat.
That's the proper place for
it's like really people. It's like, what do you think PIN stands for?
All right, let's look at the NASDAQ here because again, on Thursday after the close, we have $4.5 trillion of market cap. But that would be the Apple and the Amazon.
Huge, and don't discount the AMD, by the way, in terms of this whole conversation. No, I know that, but I'm just saying, that's important. But please continue.
Yeah. So this NASDAQ move. I mean, like you have that breakout. It's just below 14,000. That was the August 2022 high. We got to, you see where we got to 16,000. That was basically 2,000 points on a 14,000 number in just a, like an unabated rally there. And, listen, I get it, like these top 8 names make up, 50% of the weight of this index of 100 stocks here. A lot of them have been driven by the same theme. I do think it's important to kind of, X out Apple there. It's a very different exposure than what Microsoft and Alphabet and Amazon, and the NVIDIA are exposed to. I definitely think, Guy, that Tesla, as it got kind of wrapped up into this AI sort of thing. And you think about what goes into their full self-driving, whether or not they're actually or ever going to get there in the next few years or so. So a lot of those names have been, participating in the same theme.
If it runs out of steam, if Apple comes out disappointing and that starts to sort of take some of the wind out of the sails, the knock-on effect could be interesting. I mean, we obviously always talk about passive money. My concern for years has been, and sometimes it's founded, sometimes unfounded, but when passive becomes active, it's not active on the way up. And if people, a lot of people, I don't think they realize, even if they don't own Apple, the stock, if they're in the market in some way, they probably own Apple, which is in probably over 500 or so ETFs and those types of things. So whether you realize it or not, you own it, which has been great until it's not. So let's just keep a close eye on that. And listen, let's look at the VIX, which sort of is poking its head up a little bit here, and rightly so, given all the things that are going on. But the VIX is important to look at too, not to trade it, but just in terms of where people's heads are at right now, Dan.
Yeah. And, I guess people's heads as it relates to volatility have to do with like, okay, where's the Fed in the rate hiking cycle? It looks to be near done. If we look at the CME Fed Watch tool, the next meeting we have in September, it's a very low probability of another hike. Okay, so we're getting a lot of strategists, a lot of economists come out and saying that PCE data, so some of the inflation data we're getting, gives them total coverage to kind of skip the SEP meeting. We know that Jackson Hole, like the messaging there is going to be, important, but we're kind of at a point here where now we just got to focus back on corporate earnings. And it goes back to the fact that, listen, the dollar coming in the way it has, inflationary inputs coming in the way they have, that's supportive of multinational earnings. We know that the multinationals make up a disproportionate amount of, S&P earnings here. So that's one of the things that's keeping the market afloat and volatility suppressed.
Makes sense. I mean, I totally get it. I think part of what's been going on as well, the complacency vis-a-vis the VIX, I think more and more people, when you sell options, and that's been a winning strategy, you earn that premium. When you're getting paid to do it and take the risk, that's one thing. But each passing day, that thing gets more and more sort of, I'll use the term, coiled spring. You're pushing against something. At a certain point, something breaks in the volatility. And you've seen volatility events over the last couple of years seemingly come out of nowhere.
Yeah. All right, let's do it, because I actually think this is a really important conversation. I'm glad we're doing it at this stage of earnings season. We know that the banks kick off earnings season. That happened, I think, July 14th, where we had a bunch of the big money centers report
on that Friday.
And the tone was, fairly good. It set the tone for what was ended up being a good period for some of the regional banks. We had an acquisition there.
Well, JP Morgan, for example, that we'll talk to Sean about this, but 138 level, that 135 level was critical because a breakdown would have been this head and shoulders over the last 4 or 5 years. Doug Cass has pointed that out. The fact that it held and now is within a whisper of an all-time high is pretty, even by my standards, pretty impressive.
All right, let's do it. Let's bring in Sean Ryan. He's the VP Associate Director for the financial sector at FactSet, which is our fine sponsor. We get Sean, I think once a quarter, he pops on.
Whenever Sean wants to come on, he can come. He's got what do they call an open invitation?
Well, you call it an open invitation. Sean, welcome back to the Market Call. And you have a report out, and it's actually, it's like encompassing a lot of the themes that we like to talk about on this program. We want to talk about earnings. We want to talk about the tone that was set by the U.S. banks. We want to talk about the crisis that appears to be averted. You have some focus on credit and what might happen here. But let's talk about your takeaway a little bit from Q2. Let's talk about the big banks. Let's talk about the regionals. What was your takeaway? And here we are, as guys started the show saying we're firmly in the second half of the year. A lot of folks thought that maybe what happened in March and April was maybe the first or second inning of a broader sort of crises as it relates to banks, but it doesn't feel that way at the moment. So welcome and give us a sense for where you think we are, as given all the volatility that we had a few months ago, and it seems like it's all abated.
Sure. Thanks for having me back. Yeah, I think as you say, we've just come through a pretty good earnings season, all things considered. Pac West, which was sort of the sickest bank that made it through, has been acquired, and so that situation is resolved without government assistance. Earnings themselves were really on balance pretty good, and so it's kind of a curious situation. We had what happened in March and April, and the liquidity situation is mostly in abeyance. I mean, you're still having a lot of elevated balances of wholesale funding from the Fed in the banking system, still at about $100 billion level, where it was de minimis coming into March. And it'd be good to see that start trending down, but at least it's leveled off, and so that seems to be okay. But we're still having some pressure on margins from the interest rate environment, and that's going to continue for a while. But the big issue, the big question mark, is still credit, and it hasn't bitten this quarter. But I think there's still a realization there's sort of this tension, because we know we had a good result in the second quarter, but like we're at the point in the movie where we know that shark is out there in the water. We don't know where it's going to attack. We don't know with what ferocity, but we know it's out there. And then you had Sluice come out yesterday afternoon, and Sluice is like the guy in the room saying, "You're going to need a bigger boat."
I like that. He's dropping some Jaws shit.
Robert
Sean, well, as Sean knows, as I've mentioned on this show numerous times, the star of that movie was not the shark. The star of that movie was not Richard Dreyfuss. The star of that movie was not Martin Brody
or Roy Scheider.
The star of that movie was Robert Shaw, who played Quint. Nice. And by the way, the genius of that movie, they sort of happenstanced upon it because the shark didn't work. So you were introduced to the shark probably midway through the movie. So to Sean's point, you knew it was there, but you didn't see it, which made that shit even scarier. So here's my question to you, Sean. Not only are you seeing tighter credit, but we're seeing weaker demand as well, which is sort of a bit of a double whammy, as they say, as I might say, Sean, a witch's brew. Speak to that.
Yeah, this is a really remarkable indicator. We're seeing not only tightening of credit standards and falling loan demand, but you're seeing the breadth of this across the loan officers surveyed that you really have only ever seen historically at times of recession or financial crisis. Now, when you're looking at any kind of trend across cycles, you're dealing with sort of a small sample size, right? So, inevitably there will come a day where, we get a false positive. But for 50 years, the Fed's done this survey every quarter, and we've never had a false positive yet. So it's pretty ominous.
All right, so Sean, talk to us a little bit about this 210 inversion. Guy and I talk about a lot of strategists, a lot of investors are out there talking about it. This near certainty that when every recession is preceded by that inversion, especially one as long as this. But it doesn't mean that every inversion leads to a recession. It seems like almost every market participant was convinced, right, that we were going to have a recession at some point in 2023. That's when the markets was at the lows late last year. That's obviously been pushed off a good bit here. And if you look at the City Surprise Index, it's making new 52-week highs here. What does this inversion mean just for like the economy? You talked about the infusion that we saw, back during the regional banking crisis. Did all of that just kind of push things out? Is it different this time? How are you thinking about the 210 spread and the inversion and the length of it?
Well, obviously, I mean, the severity of it is pretty striking. I think, from my perspective, I look at it through the banking lens, and there, I mean, it just makes the bank's ability to sort of, borrow short and lend long, which is sort of the core of that business, a very difficult and much less profitable proposition. And so it's just one more thing kind of impeding the free flow of credit that we've been used to. It's just one more thing inhibiting loan creation.
And some of the things that we talk about, and we don't have to drill down too far, but it's not the inversion that scares people, although that is scary. It's when things start to, I guess, re-steep in the other way is when you have to be worried. And we might be on the precipice of that, because I'm going to mention now 10-year yields are above that 4% and meaningfully above 4%, at least for today. And a lot of times you could construe that as a good thing, because theoretically it should mean we're starting to see a rebirth of economic growth. But In this case, I don't think that's necessarily what's going on. So should I be concerned the 10-year yields are basically going higher again?
Well, I mean, from my perspective, yeah. I mean, again, it's kind of ominous. I mean, it's hard to have a lot of conviction. I mean, I think, certainly as you note, I mean, recession concerns, at least in the near term, have abated quite a lot. And I think one of the interesting things about earnings season that we came through is, even at the large investment banks, where like historically investment banks have, gone kind of pedal to the metal through the boom years, then they just really slam on the brakes and lay people off en masse. And we haven't been seeing that, right? You've seen layoffs spreading, but they're fairly small layoffs, and they've been continuing to even engage in targeted hiring, right? So, they're really hedging their bets. So, it's, I call it the William Butler Yeats market, the best lack all conviction. So, people really just need to hedge their bets. While it is the movement in the 10-year is a worry, but again, even with what we're seeing in this loose, if there's going to be some time where it's giving a false positive, well, maybe this is that cycle.
So, Sean, do you have any focus, at least as far as what you saw out of the large money center banks versus some of the regionals here? How are you thinking about investors who are looking to be opportunistic? Again, we know that kind of some of the regionals and their exposure and to commercial real estate and some credit issues. Obviously, the large money center banks have the issue with the net interest margin, right? Like that's a bigger contributor. How should investors think about this who want to be opportunistic, who maybe like in April and May weren't picking at some of these names, you know what I mean? But like, do you want to have a focus, one versus the other? Is there a valuation focus? Is there, when we do see a re-steepening, is there one place you'd rather be? Just give us a sense of where you think some investors who want to focus on the space could be opportunistic.
Sure. Well, I think when you look at what happened in the spring, right, you had this sort of narrative come out of it that, deposits are flowing out of small and mid-sized banks, and they're all fleeing to the too big to fail banks. And if you look at what happened in the second quarter, the data simply doesn't bear that out. Deposits en masse continue to bleed out of the banking system just because of cash sorting, given the normalization of the rate environment. But from a small versus large bank perspective, small banks are actually outperforming, and large banks generally are below the median in terms of both overall deposits and the most valuable deposits, the non-interest bearing deposits, the free money, the most valuable thing on most banks' balance sheets. The large banks are losing more than the smaller banks. The only bank that was the exception was JP Morgan, but that's because you had the First Republic transaction in the quarter to kind of skew those numbers a little bit. And so I think, from that perspective, the smaller banks have been, a little unfairly maligned. And then from a credit perspective, commercial real estate is properly a focus of concern. But even though commercial real estate takes up a larger share of small bank balance sheets compared to money center balance sheets, you're dealing with, it's the difference between being exposed to office buildings in a central business district versus, two-story buildings with, dentists and accountants, in a smaller town. And so, you're going to have a lot of variance, and some small banks will certainly manage to blow themselves up with commercial real estate. But, you're going to have a lot of banks, I think, on the smaller side that do remarkably well in terms of their commercial real estate exposure.
It's interesting. Before we let you go, and I'm not asking you to trade the HYG, but to me, and I'm interested in your thoughts, credit typically leads equities, and credit through the lens of the HYG has been going nowhere now for the last 4 or 5 months. But we'll put up a couple charts that might indicate something's about to give. Am I right to think of it through that lens? Like if credit starts to break, that might be the first sign that there's some more nefarious things at work here?
Yeah, no, I totally agree. Credit spreads are going to tell us a lot. I'm just an equity simpleton, and when the fixed income guys and I disagree, I know they're usually right.
Yeah, no, it's interesting. It's one that Guy tracks here, and if you look at you can look at some of some of the holdings in that. It's not exactly it's it's pretty diversified-ish, if you will, guys. So it like kind of serves as kind of like a barometer a little bit, but it's not something that has had too many big moves. I guess if you back it out though on a 5-year basis, I think this is kind of interesting. If you go and look at how hard it got hit in the throes of the pandemic. It hasn't really recovered a whole heck of a lot, right? So it's been kind of consolidating. It's making this little bit of a pennant. And I think to your point, it does look from a purely technical standpoint that it's going to break one way or another. It's getting coiled in there. And so I think it is really important to keep an eye on, because if it were to break lower or higher, it might give us a sense for what the next big move.
Yeah, and I think where I think it's going to break. I mean, I've thought it for a while, and the fact that we've been as stable as we have, I guess it's a good thing. But I'm just wondering, again, we talk about the inevitabilities of a lot of these things.
Yeah.
My sense is there is an inevitability, given everything that Sean just talked about, commercial real estate market, everything's seemingly coming to a head now, especially if we're going to see this re-steepening of the yield curve, potentially 10-year yields going higher. I think the market's going to start to pick up on that. We'll see. But Sean, obviously, thanks for joining us. We appreciate it.
Really appreciate
thanks for being back. Great to talk to you.
We'll see you soon.
Thanks.
I didn't make any jokes about that Jack Ryan and Patriot games and all that stuff.
You did that last time.
Yeah, and you said not to do it.
Well, I think a lot of our friends who watch the program probably remember it from last time. So it just seemed a little redundant.
That's because if I'm anything, I'm redundant.
Yeah.
I mean, some of the gags have over time, maybe they're funny the first time, then 2 through 9 they're not, but 10 through 117 it's effing hysterical.
Hey, let's talk a little bit about that 10-year. Maybe they could pull up a 10-year chart.
This is important
because I actually I'm glad you brought this up, because and you've said this, and I go back to 2018. When yields started rising, when the Fed was raising interest rates, we were like, listen, this is a healthy thing. They should normalize interest rates. Inflation was still fairly low, right? Like, we just were coming off a year of the tax cuts. There was a lot of stimulus, still kind of in the economy, right? Risk assets were kind of inflating. So the point is, if rates are going up and stocks are also going up, that's not a horrible sort of thing, right? Having an economy and a market that can deal with higher rates. And so here we are now. I mean, guy, maybe the inflation, the coming down hard enough, and maybe the recession's been pushed out. I'm just kind of and so maybe the 10-year deserves to be at 4%.
That's 100% the bull case, 100%.
Well, just I've been long the TLT, and
there's a chance of that. There's absolute chance. I just don't think that's what's going on here.
Yeah,
I mean, but again, I'm not suggesting I'm right. I mean, you can. What great thing about markets is 100 people can look at the same chart, the same data, and come to effectively 100 different conclusions along the spectrum of bearish to bullish. And that's why things move. When we talk about things being priced into the market and then the next day something moves 12, 13%, clearly it was not priced into the market. So I guess my point is, as efficient as we think things are, the markets are not nearly as efficient as we like to think they are.
Let's talk about, before we get to some single names, because obviously we want to talk about some of the big movers on earnings just today, and we want to look at AMD after the close and the semis. I think this is going to be a really important sector. I know that you also agreed. Let's look a little bit about some of these inflationary inputs, though, right at a time where we're getting weaker readings, right? We're also seeing the move in crude oil. You've had a nice call here. Look at this thing, guy. It's getting back, the crude oil futures, to that high from just a few months ago here. Is that resistance that you think it kind of gets rejected at, or is there enough going on as far as demand? And again, this kind of flies in the face in the fact that you think that the economy is probably going to start to weaken a little bit. Can crude oil have a technical breakout with a backdrop of weak economic demand? We know that China's pretty weak. We know Europe's pretty weak.
I think so. I think the answer is yes. And in the same way that these home builder stocks have sort of defied logic in terms of their moves, if you think the economy is weaker, which I do, it would stand to reason that these stocks, home builder stocks, would do poorly. We have pointed out for the better part of a year and a half now how home builder stocks are actually pretty attractive. And all three of them, until recently, are making all-time highs. But going back to crude, you're at pre-COVID levels in terms of demand. There's still a supply problem. So the China situation, I think, has been more than priced in. And I do think if you look at this chart, we're going to stop here because that's where resistance was a few months ago. But I do think as you start to flatten out in the moving averages, and as these moving averages potentially start to turn higher, I think you're going to see this reacceleration of the underlying commodity. By the way, you've already seen it in gasoline, which is actually making a 52-week high. So crude is actually lagged here in the energy space.
Yeah. All right. Let's look at gold here because the futures
Not a good day today.
No, not a good day. 1900 guy. That was the level it bounced off of late June. Okay. I think that's kind of an interesting level or so. And if you were to just kind of take your eyes and draw a kind of uptrend from those lows from, I think, late last year, and you're going to connect it to, that kind of low from earlier this year, you have a situation where this thing is, kind of breaking down at least.
Yeah.
You know what I mean? I'm just saying, if you're just going to look at it on a 1-year basis, so 1900, a test of that would be really important. When it gets there, do you want to take a shot there? Because I know that you buy gold on pullbacks, and using futures, you can kind of, even if you wanted to buy here, you could set a 1900 stop.
No, that's the right question, because the obvious answer would be yes. But the problem, of course, is if you look at even a longer term chart, I don't know if Jacob can pull it up, the fact that once again, we push towards those levels we saw a couple of years ago, seemingly have failed.
Yep.
The next time down, maybe you're not going to have that embedded support, and maybe you do break through the downside. Again, I don't think that's going to happen, but to answer it honestly, if we start to falter here, if the weakness continues, and again, 24 hours is not a day maker, as I say, that's going to be problematic to this bull case, because you look at this chart and say, how can you buy that chart with all those tops staring you in the face?
Right. So, and again, I mean, you could look at it another way. You could say it's making a little bit of a flag. It's just consolidating in and around here.
It's not a hungry, what is that thing?
It's not a hungry alligator.
I saw a video of some guy feeding like crocodiles and shit. I mean, what do people think is going to happen?
Way down in Florida?
Yeah, seriously, what do you think is going to happen?
You like that Florida man meme that exists on the internet? You know what I mean? Like they take the dumbest thing that happened in Florida, and I mean, the things that they do are just crazy.
I'm sure we have audience members from Florida. Identify yourselves if you're from Florida.
Fine. Listen, I just say this lastly, if we could just pull up that longer term chart of gold again. I mean, if you look at that, it looks like near perfect triple top there.
Yeah.
Okay. So if we do break that 1900 to the downside, I mean, 1800 is the next level. And then you got 1600 down there. I mean, and so how could that happen? Okay. So maybe if the dollar, like a move higher, right, in the dollar, that might be something that could cause that to move. But to me right now, the Dixie's had this huge move lower for gold to work again. Don't you have to see the Dixie break 100? Maybe they could pull that up.
For it to work again,
dollar index.
The dollar, obviously, you don't want it as a headwind. It would be helpful at a tailwind, but the gold story to me is it's not a prototypical dollar story at this point. Dollar is going to affect it, but it's not going to stop it, and it's not going to guide it either way. The gold story is a gold story in and of itself. We talked about central banks for the longest time. It would be helpful if you saw a weaker dollar, but I don't think it's predicated on a weaker dollar.
Okay. All right. Let's talk about some earnings. Let's hit some, this move in Caterpillar is pretty astounding.
Yeah.
This is a
new all-time high.
New all-time high. What is it about you? And I was going to say, remember 23 years ago when internet stocks were all the rage? Anything that was not an internet stock was called an old economy stock. You remember that?
Yeah, we used to call it the Rust Belt stocks.
Okay.
Yeah.
So now what would they
Rusty
be called?
America.
23 years later, what is Caterpillar? Because
it's the same thing.
It's still...
Well, people will say that it's interesting because everybody talks about how these companies have gotten up to speed in terms of their technology and stuff. Yeah. And that's why maybe they deserve a higher valuation. The reality is they're making the same shit they make now as they made 25 years ago. A little bit better, but the same stuff. It does the same things. But that flies in the face of, again, it's interesting, as I'm saying, potentially a slowdown here in the United States, China slowing down. Caterpillar tells an entirely different story when it's just Caterpillar specific, though. And in terms of some of the things we talk about, construction and home building, it all plays into it. So, yeah, Caterpillar sort of the fly in the ointment of a weaker economy.
So this is really an interesting name to talk about here, because if we're going to look at 2024 estimates, earnings are expected to grow 3%
Hold on a second.
year over
Eric
year.
Lancelotti, I'm sorry, Dan. Yeah. Gonna go out on a limb here and say The Longest Time is not G Swiz's favorite Billy song. That is such a shitty song. Oh my God, that is a shitty song. It's amazing how a Hall of Fame, a legend like Billy Joel, a Bruce Springsteen, can have some of the greatest songs ever
They have a lot of songs.
and some of the shittiest
They're not
songs
all
ever.
going to be great.
No, like that song about the irons, the Steel City,
Oh,
Allentown. Oh my!
Well, you know, it's
God.
interesting. So Billy Joel has a song
Awful.
called Allentown. It was a big hit on MTV when it came out in the 80s.
Yeah,
okay?
that speaks.
Bruce
Let me tell you something.
Springsteen in the 90s had a song called Youngstown.
Yeah,
Lots, and that was a very depressing song. All right, let's go back to
Sorry
Cat.
about that.
Let's go back to Cat here for a second. So low single digits expected earnings and sales growth. Stock just broke out to a new all-time high here. Interestingly, though, Sky, it trades 15.5 times. Okay?
Yeah.
So it's trading well below the S&P
which it does historically,
multiple, which is 19 times. That's per FactSet, which is above the 5 and 10-year average, which I think is 18.5 and 17.5 respectively. Our main man John Butters puts that out in his Earnings Insight blog every Friday morning. We get a preview of Guy. What day did we get a preview of Butters' work?
I like this Brian Harris. They make
Thursday.
the same stuff they made 25 years ago. Wake up, Guy. I mean, that is funny. I think you get my point there, Brian. Anyway,
we get it. So this thing's it's a cheap stock relative to the market.
It is cheap relative to the market. It's also high. It's a very cyclical name as well.
Correct.
So if
that's why it trades at that discount.
Yeah, and think about it. I mean, this could be that potential blow off top in a name like Caterpillar. Carter Worth, by the way, a couple of weeks ago actually was very bullish in the Caterpillar, if memory serves, on this show.
All right, let's talk about another name that's moving the opposite way after its earnings, and this would be Uber, Guy. And Uber was trading, I think, north of 50. Okay, after these results came out, and the guide that they gave
positive for the first time.
Yeah, so I think this is important. Dara Khosrowshahi, took over a few years ago. He guided to some profitability targets, that sort of thing, and he's really done I think, a very good job. I think you and I were probably fairly skeptical at the time about rideshare. They were fairly well exposed to different geographies that were having different reopening schedules as it related to COVID. They spent a lot of money moving into delivery. We thought maybe there was a big pull forward, given what was the dynamics of the pandemic, and then maybe you would see a move to greater ride share, less delivery. Well, the stock has had a heck of a move, and for whatever reason, investors aren't buying it here. The stock, I think they lost $4.50 last year, expected to make maybe 50 cents, 55 cents on an adjusted basis. Trades at a pretty high multiple. What do you do with a stock like this here?
Well, when you see a reversal like this, given the run that it's had, it's basically clearly a buy the rumor in terms of, or buy into earnings, sell the news type of event. And if this sell-off continues, you're going to break down through a pretty decent uptrend line we've had for a couple. I wouldn't want to say a couple months here, and
3 months.
The fact that we trade again, when you talk about standard deviations away from the moving average, this has been a mean reversion stock as well historically. So I'm not saying it's going there tomorrow, but today is one of those days you have to bookmark for sure, because the reversal on earnings is pretty significant.
All right. Name that's reporting after the close, which I think you and I are both really focused on, because semis have been, at the kind of center of this kind of AI movement. There's not too many pure play ways to kind of play this secular shift. One of them, the clearest one, the one that's probably gained the most market cap, has been NVIDIA. Okay, they make graphic processor units that go into the supercomputers, that go into the data centers that basically enable a lot of the compute for these large language models, these generative AI models, that sort of thing. AMD reports tonight after the close, implied move in either direction, about 6.5%. Guy, this stock, and again, you've detailed this on Market Call many times. Not a great quarter, not a great guide last
quarter,
time. Got a little. It was trading 80. It went to 130 after Microsoft, and then supposedly made some sort of partnership to kind of help them make some GPUs that would go, to kind of help alleviate some of the kind of supply issues here. What do you do with this name? Because the stock was down 9%, Guy, after they guided last quarter. And then it rallied and blew through those levels. It's come in a little bit from those lows here, trades at a much better valuation than NVIDIA. But for all intents and purposes, they don't have the chips, they don't have the quality of the technology, and they don't have the deals right now.
Well, the good news is we'll be back again tomorrow. So if I'm wrong, we'll talk about it. But what I'll say is go back and just before, you have a few hours now before they report, go back and look at the last quarter. As Dan said, the stock closed that day, I think it was May 4th at $89. They reported their quarter. They made some commentary. Stock went down 10%. And it didn't snap back that night. It was actually 24 hours or so later when this Microsoft partnering with AMD to take on NVIDIA. I can remember the headlines. That's what got the stock off to the races, coupled with the fact that AI became the rage. Everything started to go parabolic. AMD went from 80 to 135, more than almost a 65% move.
Yep.
Which was only really on the back of multiple expansion. It had nothing to do with the fundamentals whatsoever, which is fine if you long the stock, but understand that there was something happening there much greater than the business itself. So I don't necessarily think anything changed over the course of a quarter. The only thing changed is the price. So that, what'd you say, a 6% move or so?
6.5% either
Yeah,
direction.
I mean, you could get back down to that trend line, still be in an uptrend. With a disappointing quarter and the stock still be intact in terms of this uptrend we're in.
So it's interesting. If you look at the 1-year chart, you look at that gap in late May, and that had to do with some of the announcements. The NVIDIA was up in sympathy with that. And then, the Microsoft sort of news. Well, it came back to that kind of 110 level. It's kind of held there. It's interesting on a day like today where you're seeing the NASDAQ down and you're seeing the SMH, the ETF that tracks the semiconductor sector, also down. The stock rallying, 2%. Into its print tonight. So I always, again, that doesn't mean anything. It doesn't mean like somebody knows something or anything like that. But that kind of gap fill, it did what it needed to do. If they are able to come in line and guide higher and speak about demand for their, GPUs and like, listen, stock's going to go back to 130, guy. I mean, like, make no mistake about it. Just on a valuation basis relative to NVIDIA, I think NVIDIA has become a very, very crowded trade. Now, all that being said, if we go back a few weeks and listen to what Taiwan Semi said about areas away from AI, okay, again, this goes back to PCs, it goes to data center, it goes to smartphones. It's not really robust right now, right? And AMD has a lot of exposure in those other places. So if they are not able to guide up on AI and it doesn't offset the weakness in some of those other end markets, then I think you see a stock headed back towards 100.
And if it gets there, it will be still holding an uptrend line, and that might be a good entry point. And if you get that move to the upside, and if you're not long it, you say, okay, I missed it, and I'll wait for my opportunity. Because that's the way I'd rather try to buy this stock, getting back down to the uptrend line than buy it here, looking at a coin flip and see what happens post earnings.
Yeah, and I think we're at a point in this rally where it really, again, I think we just said this a little bit ago, it's going to come down to earnings now. The Fed's kind of out of the way here. Some of the worst of the kind of economic readings that we were kind of most focused on for the better part of the last 12 years have basically moderated considerably. And now how are companies dealing with a more, I guess, sustainable or, like an environment where it's a bit more predictable, if that makes sense. Okay. And then the other issue is going to be, what do these companies, what sort of ability do they have to kind of continue? Because you've said this on numerous occasions. These companies have been taking price. They're right. They had pricing power here. They did it. Okay. At some point, if we start to see margins moderate in a lot of different sectors, especially some of the more cyclical ones, that's when you will see multiple compression.
And that, by the way, coupled with margin compression, which we're starting to see, that's not particularly good. And if you start to see, you started the show by talking about an earnings recession, then you have the entire
earnings recession that really didn't happen
yet.
Yeah. Well, it happened last year. I mean, and so so last year, the stock market being down with the earnings recession in 2022, it obviously lined up with discounting what was going to happen in 2023, where earnings didn't basically, the earnings recession wasn't a year long, guy. You know what I mean? It was a couple of quarters long. So